2009, the entire G20 countries got together and had a stimulus package and then argued that other countries should also have it. So I call it Stimulus Goes Global in 2009. I think most of it needs to be studied a lot more, but I don't see that as being beneficial, but of course has led to some of the problems. Now, the amazing turnaround from the G20 meetings last year and this year is just quite striking, how it's changed dramatically. I have reds there because I don't think they did much good based on my analysis. We just had the in dollar terms, $1 trillion European rescue package. I don't know how much good that's going to do ultimately, so it's kind of a yellow. I already mentioned interest rates too low for too long. That's a red. Term auction facility, a red. On again, off again, interventions, a red. It's not everything doesn't work. And that's to be sure. This is not to say everything government does is ineffective. That's wrong. It's not true. We need governments. One of the most effective things, not just the US government, but other governments did, was how they reacted during the panic to really stabilize things in certain markets, in particular money market mutual funds in the US, commercial funding markets. And I think at this point there was a good global coordination and communication that was very beneficial to the global economy. So during the panic, and especially hard during the panic to get it right, I think you have to give governments credit for getting it right during the panic. But then this post-panic, the Fed has purchased a huge number of mortgages in the US, $1.25 trillion. I don't find that has done much good. Going back to the European rescue package, the ECB has now deviated from a policy very traditional in central banks by buying distressed debt of countries whose debt is distressed. And then I also have the Fed has actually joined in that rescue plan by providing currency loans, foreign currency loans called swaps. I looked at that. I don't think that's been too effective. And again, we could go on. I mentioned regulatory policy deviations. The banks in the United States, the most heavily regulated set of institutions, and that's where most of the problems were. So it's not like regulation was not enough, it was just poor. Deviations from the Stability Growth Pact. Geez, if those had not occurred, think how much different things would be now. If the Maastricht Treaty, deviations, Stability and Growth Pact had been followed, let enforced. And then you say, what's next? Well, I started this work, this page was a blank. This page was a blank when I started my work. I just hope it doesn't get more and more, so the print gets smaller, or I have more and more pages before I'm finished. But I don't know what's next. Maybe more stimulus packages, maybe more bailouts. I certainly hope not the end of the euro, because I believe the euro has been very beneficial. And the euro is not the problem, it's the debt creation by certain countries that has been the problem. Okay, so very briefly, I think if you follow, at least to some extent, or are sympathetic with this position here, trying to base the facts, and you come to pretty obvious policy implications. One is to try to avoid these interventions as much as possible, to avoid these stimulus programs, at least not to do more of them, but get more to the austerity, which fortunately people are thinking about, trying to reduce the structural deficits. Monetary policy is the most straightforward thing at all. Get back to the policies that were working, actually the policies that I think have been followed consistently in some countries like Poland. Financial reform, I think it's not so much that there wasn't enough regulation as that the regulation that existed was not done very well. I think you can do that best by keeping the rules simple, don't have conflicts of interest, so the regulators, supervisors do the right thing.